It's Daryl King here, sharing the mindsets, and I got my good friend Raggy from Mortgage Savvy, and she's come in here to help me talk about the new mortgage rules coming out on December 15th, because I think this is exceptionally well for clients that have to renew their mortgage, extend their mortgages, and different things like that for the stress rules. What are your thoughts on the new rules coming out? Introduce yourself first to them.
I'm Rachi Dingra, and I am the broker of record for Mortgage Savvy. And when I started Mortgage Savvy, it was to help individuals become mortgage free and look at real estate as a wealth building and an investment tool. Now, speaking to these changes that are effective December 15th, much needed.
Well, totally much needed, right?
Much needed. And I think that they are probably the most significant reforms we've seen in over a decade.
I agree. So here's what I read right here. The Canadian government has rolled out significant mortgage policy changes effective in late 2024, which is December 15, aimed at making home ownership more accessible for first-time buyers and addressing the affordability challenge in today's housing market. But will these changes truly benefit new homeowners, or are they more of a temporary relief? Let's break down the numbers and assess these real impacts. So what they have here is the key mortgage reforms to note. So increased mortgage cap. The federal government has raised the interest mortgage limit from $1 million to $1.5 million, effective December 15, 2024. This adjustment reflects current housing market realities, enabling more Canadians to qualify for mortgages with down payments of less than 20%. So what's your thought on, let's just deal with that one first here.
That is a much needed reform. If you're looking to buy in Toronto and the GTA, that $1 million price point can be very limiting. So being able to expand that to 1.5 or 1,499,999.
That's really what it is. We're just capping it right at 1.5. So it's just under 1.5 in reality, but
it opens up opportunity. It opens up opportunity for people to look at the option of going out there and buying that first property.
Yeah.
It's also important to note that this cap or increase to cap applies to anybody looking to buy a primary residence with less than 20% as a down payment. And that is often the challenge.
Well, it is, because really, we're in Richmond Hill, the GTA call it, but for $1 million, for most part, you're looking at maybe a townhouse, a semi, or maybe an older bungalow of certain years, whatever the case might be. And there's lots of condos that you can pick up for that, but you're limited. So by going to 1.5, it opens up a much broader horizon for everybody.
Absolutely,
right?
And it allows people to take on a property that is going to have longevity, 5 years plus. And isn't that the best way to start actualizing on some equity gain or some wealth building through real estate?
And what I always thought of, like my parents owned their house for 39 years. But I always thought my late father's passed away, but if they had sold their property 4 times, I probably would put $1 million cash into my mother's bank account today. So really, they say first-time home buyers are going to probably move out in 5 years and upgrade. They built up equity. They're making more money. Hopefully, rates, hopefully are going to stay. All right. So extended amortization periods. Now, you're going to talk about this more. So what it says is eligibility for 30-year mortgage amortizations has been expanded to include all first-time home buyers and purchasers of new builds. This extension aims to reduce monthly mortgage payments, making home ownership more attainable for younger Canadians. So I want you to explain that, because it doesn't seem to appeal to everybody here, how the people will benefit from this.
For sure. First-time home buyers that may currently be renting, the idea of taking on a purchase can be a little bit overwhelming, because you're now having to take on a mortgage payment and additional costs associated with owning a home or a property. Going to a 30-year amortization allows you to minimize that monthly obligation. It helps extend that mortgage over a course of an extra 5 years from 25 to 30, lowering your payment. And what is surprising when I'm working with first-time home buyers to run this comparison, it's usually very much in line with what they're paying on a rental at the moment.
So imagine that you're paying rent, say you're paying $2,500 a month, just say $2,000, $2,500, whatever that number is. It depends what you're purchasing. So you can actually have home ownership, because we know if you rent it for 5 years, you're paying $2,500. You know, that's a lot of money gone out in 1 year. So you have zero equity after the 1 year. You imagine then 5 years. So after 5 years, you built up equity, you built up with the banks. So now it's easier to borrow, right? Because now they've established themselves.
For sure, it makes it easier to qualify. It helps keep your payments in line. And what's important to note as well is that as your income increases, we can revisit your payment and help you accelerate those payments as well. So there's a strategy that we can employ, but moving from renting to buying, when we're looking at the numbers, because math is self-explanatory, the numbers now speak for first-time homebuyers to be making this move. And if you are going through a separation or a divorce and you have sold a property, your first-time homebuyer entitlement under this program does reset. You have the ability to look at purchasing a property and using that 30-year.
So let's be clear, because I'm not. So let's say that I'm married and now I just get separated. So under the separation thing, now they're going to let me qualify as a first-time homebuyer.
That is correct.
So I'll tell you what, there's a lot of audience out here that don't know that. And probably, I would say with 100 people, there's only a few percent that probably actually know that. So understand, because we all go to get married and great, you know, we hopefully longevity, but sometimes things just don't work out. Now you both are in one house, so generally you can afford half of what you got, because normally you go 50-50. But at least under these rules, if you can qualify the first time, you can qualify up to 1.5%, $1.5 million mortgage, and at the 32-year amortization.
Correct.
Right?
Correct.
Now, so this, because if I'm just a resale person, I don't qualify for those things, right?
Well, you could go to still buying a property with less than 20% up to that 1.5 mark, but you would be limited to that 25-year am.
Right. So there's a bit of advantage to that. So hopefully, maybe we'll see further breakthroughs moving forward.
Hopefully.
Let's take the first two breakthroughs again. So how would you rank this from 1 to 10, the standard amortization periods?
10.
I would give it a 10 also, because really your payments are not increased; they're just extended. I mean, you know, people used to take a 25-year am basically, and look to pay it off in 25 years. So when houses were cheaper, you could do it, but most times they're not. Everybody's got to renew their mortgages anyway. So if you're paying $2,500 for rent, you're getting no equity. You're paying a homeowner's mortgage. So now after 5 years, you built up equity, because, you know, really what I'm seeing is we're probably pretty much at the bottom level of where the market's going to be. And as the rates continue to drop down, prices will slowly start to, and I'm not saying they're going to go like this in one day. It might be another year, but over 5 years, you're going to see increased equity in your home, guaranteed. So, you know, just look at history. History repeats itself. So 2 10s in the first two. So here's another one I think is a real smasher, and I think you're going to agree on this. So removal of stress tests for mortgage renewals. Like, wow. So what this means, as of November 21st, 2024, the Office of the Superintendent of Financial Institution, OFSI, eliminated the requirements for borrowers to undergo a stress test when switching lenders at mortgage renewal, provided the loan amount and amortization period remain unchanged. This change enhances competition among lenders, allowing homeowners to secure better rates more easily. So explain to them what that means, because some people don't understand what that means. Let's give it to them in layman terms.
For sure. When we're looking to qualify individuals for a mortgage, we've typically had to stress test. And what that means is qualifying at a rate that's 2% higher than the contract rate. And that can be overwhelming. So if you've owned your home for some time, you have a mortgage on the property, the idea of having to shop for a renewal rate on your mortgage can feel overwhelming or unattainable under these new guidelines. With these changes, we can now go to market and make sure we're getting you the most competitive rate. So we urge clients to ensure that they're connecting with somebody that can provide them with that guidance. Demonstrate the options available, review what their monthly payments are, because that's what this comes down to. As much
Totally.
as it's great is, rate is the conversation that we keep hearing. What it really comes down to is, what are you comfortable carrying on a monthly basis? And that is something that we strive to provide clients with support on.
So with this right here, when your mortgage, so they say 85% of active mortgage are coming up in 2025.
Correct.
Okay? So what this means, if this hasn't happened, so let's say I'm at XYZ. I won't name a financial institution, so it's not fair. But let's say I'm at XY financial institution. I'm locked, the way the old rules was, I was basically locked into them. I couldn't really make any changes. If I did, I would have to go through all the stress rules, all the requalifications again, and lots of people, they're entrepreneurs and stuff, their income probably in the last 2 years is down more than the peak years. And the rates are higher than when you had got that mortgage. I would guarantee, like I was at a place last night, I just listed, he had 1.5%. He still got a year and a half on it. So I'm hoping that whoever buys it, it's 5 acres for $8.99. So if you're looking for a nice place right up in New Tecumseh there, nice little dollhouse, beautiful, on private 5 acres for $8.99, and it's got 1.5% mortgage that's assumable for another year and a half. So now if you had to go renew that rate, what rate would that person be able to get today? Do you know offhand?
You're probably looking at, depending fixed or variable.
Let's go fixed for argument's sake, make it easier.
You're probably looking at a rate around 4.3% on a 3-year.
On a 3-year. So he had 1.5. So if he had to renew today, it would be 4.3, and then he would have to go requalify.
Absolutely.
Right? And under the old stress rules.
Correct.
So he wouldn't be able to borrow as much money, most likely. So, I know that myself as a realtor, that I'm figuring that there's going to be a lot of desperate people coming up in 2025 that have to renew their mortgages, that are going to basically have to sell because the affordability, because most people, when the market was so hot and interest rates were so low, they were overextending and maximized themselves to the highest amount that they could get. And now those rates are still higher no matter what. I don't care what rate you want to go get today, it's not as low as it was. And maybe your income even is not. And then if they had the mortgage stress rules on top of that, you'd be like feeling like this, because you might not be able to get that amount. So with these new rules, they'll be able to qualify as long as they don't make changes. So if you take your same amount and that, you can still go.
Absolutely.
Right?
Absolutely. And there are solutions for clients that may assume that they're going to be challenged. Working with a broker that's able to position a file with a lender and build a business case as well may have success. So it's so important that you're speaking to somebody, getting the information, and really ensuring that you're working with your affordability in mind.
Right. So my clients would have to, they've got, so many of them are coming up with mortgages now. So now I can say, go give Rocky a call and let her go shop around for the best rate and terms for you. Before, it wasn't possible. But with the new rules, it's possible. So I would give this 11 myself, this one here.
Absolutely.
Right?
The amount of relief, absolutely, I agree. That's an 11.
Because it's going to take a lot of stress off the homeowners and a lot of stress off the banks and a lot of stress off the realtors, right? And even the mortgage brokers,
For sure.
because now they got options for them.
We
right?
are here to provide solutions for clients.
So these three things here, we'll give a top 10 for all of them. So like I said, as she said earlier, it's probably the best thing they've done in a decade to help buyers out and people that got to refinance. Because it's not always about refinancing, is just as important, right? Because a lot of people are going to be forced. Now with the new rules, they may be able to do the refinancing, get it in at a rate that's affordable for them, and stay in their home.
For sure. We've been breaking a lot of mortgages for clients that locked into a fix in 2023 and 2022. And we've had success in getting them a lower interest rate on their mortgage. A number of clients will automatically assume if they're in a fixed rate product that the penalties are significant. There's loopholes. Let us educate you on your options. It comes down to the numbers. This isn't a decision on opinion. It's about the numbers. So ensure that you're doing your homework, that you have the information, and you're making an informed decision.
So I got something here, because I'm going to come back to that, what we were just talking about. So here's what I've got here. Mortgage savings, the numbers you need to know. So this is scenario 1, refinancing with lower rates. A homeowner currently has a fixed term mortgage of $700,000 with an interest rate of 5.5, which was locked in 18 months ago. Today's rates for comparable fixed term are about 3.5. I think it's higher than that.
It's higher than that.
It's high, it's like
We've definitely seen
4.5.
It's slightly lower than that as well. You know, we're definitely
4.3?
seeing, I'd say about 4.3.
So I'm just going to mark this. So 4.3, 0.434.
So that's over a percentage point
Right.
sort of
So that's a
delta.
major amount. So what they had on here on this example, because this is where we got it, monthly payments at 5.5, current rate approximately $4,300 per month. So based on that, at the 3.5, this would actually be higher. So it says monthly payments at 3.5, but we would have to, would you know what that is offhand?
I wouldn't, unfortunately, but
Yeah.
what I will communicate is that the delta is significant enough to really support with affordability, but there's another piece that we are missing, and that is the overall interest savings, not just the monthly payment coming down, but the overall interest that you're saving over the term of the mortgage.
Because how this example was, you could be saving $860 a month. That's $10,320. So it's going to be not quite that much, but it's still over 5 years. It's $51,600. So maybe it might be only $40,000, but $40,000 in your pocket is better than $40,000 in someone else's pocket.
For sure, and
right?
we've simplified this process. So Mortgage Savvy, we have a desk, and we refer to it as the penalty desk. All you need is every page of your last mortgage statement. So the last mortgage statement that you would have received would have been January 2023. You send us a full copy of that, and we're able to run these numbers, give you an assessment of savings, the cost of breaking the mortgage, which may surprise you, and give you the information needed so that you can make an informed decision.
Yeah, so this calculation reflects a 20% reduction in monthly payments, demonstrating the saving homeowners can achieve by refinancing in today's lower rate.
Sure, and oftentimes that's the difference to keep someone in their home.
Right? So this is situation 2, increased purchasing power with a new policy. So let's just see what they have here. Previous mortgage here was $1 million cap. So new policy allowing for 7% increase in purchase power enables buyers to afford homes at a higher price point. So here's an example. Previous mortgage cap was $1 million. At a 20% down payment, buyer could afford a home up to $1.25. New mortgage cap, $1.5 with the same 20% down payment. Buyers can now afford a home up to $1.1875, right? So in this one here, increased home price $125 for every $1 million, or 7% higher purchase price. So a lot of different affordability, and these might not be accurate because they had that at 3.5. I don't know where this was printed off for me, but the adjustment significantly expands the range of home buyers can get. So what does this mean? Reforms will need greater flexibility and affordability, especially in high-priced markets. So the good thing is the high-priced market has come down substantially. So the rates are coming down substantially. With this new things, the 3 things, increased mortgage cap, the extended mortgage amortization period, and the move of the stress test opens up the doors tremendously for people to refinance and to purchase. Right? Home sellers, expanded pool of qualified buyers can lead to an increased demand for your property. Investors, enhanced financing options and more dynamic market present new investment opportunities. Because we know for the investors, like with a lot of the changes, is really crushing them, right? So some of these are going to help you out also. So I know what they had here, just a little category. So first-time buyer, purchase price limit 1.5, non-first-time home buyer.
Still 1.5.
1.5. Down payment 5% on the first 500, 10% on the remaining 1.5.
So that is $125,000, and that's applicable to a first-time home buyer or somebody looking to enter the market.
So basically, if you want to get up to 1.5, you need $125,000
Correct.
deposit, right?
Down payment.
So whether you've saved or, I don't know, borrowing from the family, does that count?
Gift from family members.
Right,
is
so
something we see on.
family, right? So that's the same as first-time home buyer and non-first-time buyer.
Correct.
Amortization, 30 years and 30 years. So first-time buyer on the resale is 30 years.
Yes.
And then,
So for a non-first-time home buyer, if you're looking to buy up to 1.5 with less than 20%, you would be limited to a 25-year.
that's 25.
Correct.
Yeah, because I had that here on this one, the resale
Correct.
was 30 and
Correct.
25.
Correct.
So
Correct.
there's lots of opportunities that were not there yesterday. As of December 15th, the one started November 20,
The 21st.
the 21st, right? So that was with the removal of the stress test.
Yeah.
So that's already in effect. The other two are going to come in effect as of December 15th. So if you're thinking about making a look, give Ricky a call, give them your number and your email.
So you can find us on Instagram at Mortgage Savvy. You can call us directly at 416-720-7295 or my first name at msavvy.ca, and that is RAKHEE@msavvy.
We'll put it in here that just got to push a button.
Yes.
And us, like, you want to find out, you know, for our agents, we can have them start to search for you. You can give us a call at 905-907-5464. Our home's at darylking.com. Again, we'll have this in a little thing. You just push it in and it'll be there for you. So, Becky, this is very, very informative. I know that, you know, the one about being separated, that was the one I didn't even know myself. So you know, the options are there. So we want to thank everybody. We hope this was helpful for you. Want any other questions, give her a call or give me a call, and we'd be happy to answer them for you. Take care, be safe, have a happy holiday.
Happy holidays.